Ladies and gentlemen, welcome to the Sofi Stock Earnings Q2 2026 live stream. Joined with me today is the great and powerful Neil, couch investor, Roy from Crossroads, and joining us right now, Tevis. How you doing, brother?
I'm good. Hold on. Let me just get set up. Are we live?
No problem.
We are
No
live.
problem.
Oh, yeah, we're live. Okay, cool. I'll be right there.
Neil, you excited for today's print?
I'm very excited. You know, I've had worse Wednesdays. I just came back from playing golf. Now I'm going to talk about SoFi. Then later we're going to talk about Meta and Microsoft. So I've had worse Wednesdays.
Yeah, well, it's 6:56 a.m. right now. I'm tired. I don't know why SoFi picked this day because we're gonna go see FOMC later, and that's not new. We know the date of the meetings years in advance. So I think that it's going to be very interesting to play around as a bank the rate decisions that are going to come hours after we end up seeing guidance. That seems hard to me. Roy, what do you think about that?
Yeah, it's the worst possible time to report, but you know, I think it's just as simple as it fell on the best day for the company with whatever they have going on. But
Mhm.
yeah, I hope that doesn't overshadow, but it will overshadow earnings a bit. But yeah, regardless, I think it'll be a good quarter. Always excited for these, and really excited for the updates on the new product line.
Yeah, and I agree with you. I don't think it was intentional to be like, "Hey, let's pick the worst day." It's, whose schedule all aligns with them all being in the same place, and you know that's how it's going to work. But it's just unfortunate that it lines up with um, the thing that's holding the stock down. Tevis, sporting a large McDonald's coffee. How you doing?
I got a coffee. I just finished my bagel so that the chat doesn't watch me eat it on camera. And yeah, ready to roll. I
There
mean,
you go.
I'm with Roy. Like they can't do anything with guidance. It's a catch 22, man. Like it's a you have a technical ceiling on the stock, right? Like if the Fed comes out and they keeps rates the same, and so if I double beats and they keep their guidance, that's the best case scenario that we can possibly hope for. Nothing sort of better than that. They're not going to raise their guidance. The Fed's not going to cut rates. Like so, you have a ceiling, right?
Yeah, so I said to Tanner just before, I think guidance stays the same. Their assumptions just gets worse. And that's, I guess, a win in their book, right? They're now going to say we are expecting a rate hike, but guidance stays the same.
Yeah.
I guess they play the same thing they did 3 months ago, where the assumptions got worse, guidance stays the same.
Yeah.
So one of the funny comments that I've seen from this is this shows we were complaining about it in previous years, but how much they sandbag, how cautious they are when they can go from 2 rate cuts to 2 rate hikes and be like, yeah, we'll just keep the guidance the same. Wow, I'm glad.
So by the way, guys, for anyone wondering what we're doing, chit chatting, the numbers should come out here in 55 seconds. But until that point, and it's not always guaranteed at 7 o'clock, there might be some searching around depending. We are just waiting. The schedule, the way it's going to work today is that between 7 o'clock and 8, we're going to be discussing the numbers. Tevis is going to be taking over the presentation so I can plug my my spreadsheet. I'll wait to say that whenever we're public. That way he's not going to say no. And then from 8 to 9, we're going to be listening to Anthony Noto and Chris Lapointe on the call. Maybe 9 to 9:15, 9:30, we can end up discussing what we thought of the call, the numbers, all of those things. So strap in for a few hours, go get a coffee, but be prepared to see what's going to happen to your portfolio now. It's 7 o'clock. Let's see who's got the numbers. Let's see. Like I said, it can take a minute. Tevis got the numbers first last time. What are we seeing here?
And a good reminder for folks too, as we see that
They're
green
out.
needle move
Double
around.
Double
Okay.
beat, 12 cents of EPS, revenue 1.2 billion. Revenue is up 41% year over year. EPS is up 50% year over year. Just the top and bottom line right now.
Yeah, it's better than I was expecting on EPS and the revenue as well. Slightly ahead there too.
Yeah, there you go. Double beat. We don't have guidance just yet.
Okay,
Those
so
are the
revenue
numbers.
beat most of our predictions. EPS came in, I think, in line with some of our predictions and maybe a cent lower than 10. Are you at 13?
Yeah, I think so. Yeah.
Yeah, okay.
I had
me too.
11.
Okay, so win for us combined.
Yeah, my predictions were high on financial services, almost by like 25 million, or might have been 35 million. So I'd have to go back and see how that affected EPS. But
Presentation is live already, I think.
Yep.
Yeah.
Okay. Adjusted EBITDA up 44% to a record 358 million. Total loan originations hit a record of 14.8 billion. Oh my gosh. Members grew by 35% to 15.8. That looks like 1.1 million right there. Products up 42%, faster product growth than member growth. Obviously, you're going to see some cross buy there because more members versus products. Now, there was an adjustment with the way that they calculate SoFi Invest members, which I think is a little bit, we're starting to see a change in the number of new products per member, but it's not actually changing the financials on the other end. So that's a little bit weird, but let's go ahead. Actually, I just want to dive to that really quick to see how much of a change
You
that
want to
was.
dive to guidance straight?
Yes, actually. I don't know why I'm doing SoFi Invest. I can look at that later. Increased 2026 adjusted net revenue guidance to 4.75 billion to 4.85 billion. What was it before?
Yeah, so they are now expecting 32 to 35% year-over-year growth. The previous
Versus
number was
30.
30. Yeah, and EPS stays the same at 60 cents.
Triple beat.
The guidance is really surprising.
Yeah, I mean the fact that the revenue is increasing and EPS does not get affected at all is not bad.
Just
Not
goes to show
bad.
how much they actually stand back, or how conservative they actually are if they're able to raise guidance, even if it's just a little bit, right?
Ahead of a
Yeah.
FOMC meet.
Yeah, exactly. Which last time they were ahead of a NOFA as well.
Wow. Okay, so far so good. I'm looking at the stock. Stock's down 2%. I'm trying to figure out what is it. Tech results? Maybe.
It's because it's a triple beat. It's the usual stuff.
What do they?
Tech
Do they still
platform.
call it just tech revenue?
No, they renamed.
I know. I'm just saying. Where? What's the? If they don't
No,
call
no,
it
it's
Galileo
still-
members,
It's still technology platform. They are now. Yeah, no, it's still technology. It's at 85 million, by the way. 85 billion in revenue. So way more than I thought.
I think that was in line with one of our predictions. I don't remember. Someone said 80 something.
I think that might have been you. You were in the 80s, I know.
I was
I'll take it.
78.
Tanner was 83, and then Roy was 77.
134.8 million total accounts. Is that
Only 2 million accounts added, basically.
okay? Yeah, but that's no reason to sell the stock off. Okay, the stock's coming back a bit, 0.5 now versus down almost 2%.
Yeah, I mean, like, even if these were like ridiculously strong, although honestly, the guidance should be the signal, because when you're like coming out as a company, last time you punted on guidance, you said, "Hey, it's uncertain." This is the most uncertain FOMC meeting that we've had. I believe, since 2022. It's been a long time, guys. And so just saying, hey, rates impact us a lot, but we are so strong right now. We don't care. We're raising guidance. That is a freaking signal.
They added a products per member chart too, 1.54.
Yeah, but like I said, it's not. It's
Yeah.
calculated differently now. So I don't know.
1.1 million members. So we all got that right.
Yeah, products per member there.
So what's our total growth rate? 43%? Sounds about right. Yeah, $1.2 billion. Jeez.
Cash revenue at 100% still.
Oh, wow. Yeah, I just saw that slide. Yeah.
Wild. Fee-based revenue mix in Q2, 39%. I think that's higher than last quarter. Yeah. Margins of 30% on adjusted EBITDA. Tangible book value grew in Q2.
Financial services also grew this quarter. So small quarter-over-quarter increase here as well.
Wow, that is not as much as I wanted to see.
Yeah, but maybe they did the same as last quarter with the lending and financial services, and they still increased it because last quarter it dropped quarter-over-quarter because they kept more.
Wait, look at this slide real quick. Anyone notice anything?
The referral? No.
Look at the loan platform business. They have auto and SMB loans on LPB. They didn't have that before. Let me see if I can pull that up and see if that was there last quarter.
While you're doing that, yeah, the financial services revenue, like that's basically that's where if you guys have forgotten, if it's been a while since you've looked at SoFi, the loan platform business revenue goes on that, and then the lending, of course, goes on the lending side. So last quarter they talked about this shift between do they lend and add a bunch to their balance sheet that's attractive, or just asset light and selling to their partners. That's the loan platform business of financial services. So it's always a guess as far as like how much they do. This is actually 2 million higher than my estimate on financial services. So yeah, you had the large number there, but it's just a guess as far as where on that spectrum they go.
So if I look back at last quarter, this was that same sheet, and it's just personal loans on LPB. Okay, now if we go over to this is Q2, now they're including auto and SMB loans. But I assume it's mainly leaning on the SMB loan side of this. But yeah, a little interesting there. And also no personal loan sales once again.
Yeah. So I guess it's again they decided more balance sheet lending and less LPB volume this quarter.
Yeah. Which I'm actually surprised. We need to go back and look at Q1's. This is one of those quarters that we need to really start plugging some numbers because
wow, wait, 724 million in lending revenue?
712, yeah.
That's substantially higher than all of us were thinking.
Wow.
Yeah, I had 640 or something. Yeah, 640. So even that's
the interesting thing about that is you could look on their website from the very beginning of the quarter on. They continue to raise rates all the way through as far as the rates that they're advertising, the floor. So as they were going through, like they were like, hey, we can go ahead and adjust these rates. A lot of companies did too, but these are going to be the ones that they make a lot of money on as long as there's no huge spike in defaults or anything like that, which they're pretty cautious usually.
Yeah, look at the originations for these. Like by Q3, we're gonna have more originations than we did in all of 2025. I'm sure they've already passed their amount of originations in 2025 just based on July's numbers here for student loans. And then home loans, another one. One more quarter, and we're going to pass all of 2025's originations.
You want to see something really cool? Slide 25, the consistent credit performance. Look at that number on the personal loan, the net charge off, the middle one, 2.62. This is going back to rates that in 2023, most companies were saying, well, we have low default rates right now, but these will eventually normalize. This is, man, that's really strong.
Yeah.
So, yeah, I'm just kind of wondering, like, if with this, so we saw some other financial services, banks as well, talk about the resilience of the consumer. We've seen some good credit performance reads from other companies as well. So Sofi might just be saying, like, hey, everything looks really good there. We're going to lend a lot. We got a lot of money that we raised. We're going to make a lot of money.
Yeah, I mean, not to mention they're loading so much of their growth in the back half of the year for EPS. They're still they're guiding for 60 cents EPS. And it's like, all right, well, Q1 did 12 cents, Q2 did 12 cents. That's 24. Where's the rest? They're loading up a ton in the second half of the year.
Which is pretty normal for them, right?
Yeah, but
Yes.
I don't know to that degree.
And in this environment where rate cuts, rate hikes, nothing happens, I don't know. But
Chris was in chat. Chris, this is a great slide. We've seen this slide before, but not the quarter over quarter comparison. And you know what? I used to even look at this slide and be like, it looks like I don't know. I'm not smart enough to see much difference in the chart every single time. But as time progresses, you want to see that this is actually getting wider and wider. So this is essentially looking at the vintages on our loans going all the way back from 2017 to now. And they write these loans trying to assume that they are going to get to somewhere around an 8% like life loan losses. But as you can see, back in 2017, not only did we beat that number already, but then these loans that we're starting to produce from 2022 all the way to now or a little before now, that these loans are performing way better and are on track to greatly outperform 2017's vintages. So it now would be, I'm so tired I can't even read this. What's the thing? In order to surpass 8% life loan losses on all Q1 2020 to Q1 2026 originations, the remaining 38% of unpaid principal, meaning all these loans have been fully paid up, 62% of them, would now need to have like 10% loss rates just to get to that 8% because we've done so much better on their expectations that the next part would be so much past what anyone would ever expect from these loans. And by the way, the high amount of loan losses come in the first 18 months, not at the last, 38 months. So these are on track to do extremely well. Chris, tell your boss to do these streams at night. I'm failing to talk and produce words because it's 6 a.m. And I know it's worse for you. It's like 4 a.m. where you are.
Yeah. He is doing them at night.
Yeah. Probably best just not to go to sleep.
Yeah, bro.
Okay. Yeah, SoFi stock is down almost 4% right now. It's 7 a.m., so I wouldn't look too much into the amount of volume that's, trading on the stock right now.
And the call hasn't started at all. So still waiting for some comments. What they think about guidance, what's their assumptions. I'm comparing now quickly Q1, Q2, seeing if there is much difference. So like you said, fee-based revenue mix is now 39%. Last quarter, that was 36% of the mix. Fee-based revenue annualized last quarter was 1.5 billion. We're now at 1.9. Adjusted EBITDA margin is 30% for this quarter. That's down from 31% last quarter, if you really want to nitpick some of the stuff here. But other than that, again, a pretty solid quarter here.
Yeah.
Yep.
Yeah.
Yeah, on the lending side, like almost all of that rate of increase, there was some on home loans, actually a pretty nice increase there, from 1.2 million to 1.4. So that was actually a nice step. But personal loan originations, and I think that maybe that's the only thing that if somebody's looking at these earnings, at least what I'm seeing, what somebody could criticize is, oh, well, they grew revenue, but it's the least impressive way because it's personal loans, and those are easy to give out, and they're risky. But we've
Yes.
already seen the vintages. There's not really. SoFi is conservative in the way that they handle these things, so I don't see that risk.
Yeah, no, that's exactly the thing, right? Is like you said, it's really easy to give out a loan. It's hard to get your money back. So SoFi has obviously seemingly perfected that. But if you want to say, hey, this is so much more than a bank, then you need to show up with technology platform revenue and financial services. And if some of those things slow, well, those were like the leading drivers of growth previously. So are you kind of holding up the growth by going through your balance sheet, or did you raise a ton of money because this is exactly what you were planning on doing in the first place? You know? Okay, Tevis, I think it's about that time.
Yeah, just give me a sec. I'm almost done plugging in mine.
This guy.
Corporate was the only other number that I saw that we didn't put up there is almost 57 million. So we always just estimate that. Negative, not positive.
Oh, they added a new products line item for SoFi Plus.
Oh, yeah?
Oh,
Yeah. 206,000 members for SoFi Plus.
Yeah, it's...
And also credit card back added 73,000 for
Thank
the
God.
quarter, which is materially higher. It's like the highest they've ever added for credit card.
Yeah, it's almost like 2 quarters in a row. But last quarter, there was nothing. So...
Yeah, last quarter was like 400. So let me add this SoFi Plus one.
yeah. It seems like this is a report where they're likely to say, "Hey, consumer looks extremely healthy. We're going to take advantage of that."
Which is what all the other banks said as well.
Yeah.
They said spend was high, consumer is healthy. No bad signs so far. But the stock is acting like the FOMC just raised rates. They must get it earlier than us.
Why do we think, like, just out of curiosity, like, why do we think that it's down? Like, if we had to steelman the other side.
Higher amount of lending revenue.
Yeah, the personal loans. That's if it was financial services, which is asset light and has no risk. I think that the reaction would like it more, but I mean, like at the end of the day, they didn't raise all that money in December just to let it sit on the balance sheet. They're going to use it.
Mm-hmm. Yeah.
You can see it in the capital ratios are down quarter over quarter. People might freak out, but they're way above the required minimum anyway. Like last quarter, they were at around 21, 17.7. This quarter at 18.7 across the board and 16.5, but they only have to be at 7, 8.5, 10.5, 4%. So still way above the minimum.
Okay, you taking over, brother?
Yeah, I can take over. All right, What do we want to look at?
Go through the earnings release. I'm sure there's going to be some Noto quotes in there that we haven't seen yet, and stock-based compensation, these sort of things might be helpful.
All right, let's see. 42% increase in products, 35% increase in members. This is an acceleration in products year over year and quarter over quarter, by the way. Products increased about 10% quarter over quarter, which is higher than I think any of us had really forecasted.
Yeah, yeah, but it's part of it is again how they distinguish the invest side. So,
Yeah.
but I'm glad that they included the SoFi Plus. That's really good.
Marking the first time SoFi added twice as many products as members in a single quarter and reflecting the increasing engagement of existing members. Products per member reached a all-time high of 154. Cross-buy continues to accelerate. 51% of new products opened by SoFi existing members, up from 43% last quarter. Inflection point to products per member driven by SoFi Plus. Yeah, it's kind of interesting that they're now introducing SoFi Plus and like the actual product numbers. Wait, I mean, like, don't you double count then?
What?
Well, because like if I have SoFi Plus and I have, a money or invest, like, am I not double counting? Because SoFi Plus is just like the sort of umbrella on top of it. But I guess I'm paying for multiple things. So
If they're counting it in products per member,
yeah, that's what I'm saying. Because like you could be a SoFi Plus member, like a subscription holder or whatever, and then you have 2 products or 3 products, like they would count an extra one for you.
yeah, it's kind of like counting Relay as well. Like some of these products that kind of don't do anything, and
Yeah.
but this one it is revenue generating. I don't know.
Yeah, I was gonna say Relay doesn't. It's not that it doesn't do anything. It doesn't add. It's part of that flywheel.
It's free.
So
It's
yeah.
free.
Yeah.
Did
Among
they?
existing members who signed up for SoFi Plus, 25% added another product after adding SoFi Plus.
That's good.
Did we get other than the now 200,000 paid SoFi Plus subscribers? Did Noto tell you a number when he spoke with you guys, like 2 months ago, a month ago, or something? Like, did he say that?
I think you're
after they
thinking
launched?
of Amit and Steve.
Maybe, I don't know, but I assume you know the number as well.
Of what was that?
SoFi Plus subscribers after they launch.
Oh,
I'm
yes.
pretty
No,
sure
I know all the numbers. During the conversation with Amit and Steve, he said that before, like they've had this subscription service open for a while now. They had 60,000 people sign up. Then 6 weeks after they launched, like taking away the direct deposit version, and they did the full transition, they got 100,000 new people in 6 weeks. So they had 160,000. Then there was another update. Anthony Noto was on like CNBC or something weeks later, and they had 180,000. So the pace of growth since launch has definitely slowed since the updates. And I remember it wasn't a CNBC interview. It was a fireside chat. He did a fireside chat recently. And we went from essentially 160,000 to 180,000. And now I forget what it was, like 206,000 or something.
Yeah.
Yeah.
Unaided brand awareness over 10% now.
Over 10%?
Yeah, 10.4.
10.4% for what?
Unaided
Brand
brand
awareness.
Oh, okay. Yeah.
Tech platform is continues to be the lagging one here.
My expectations were so low though that it's like, hey, this is a nice surprise.
No, so to me, this is also a surprise. I had 78 million, but we know the number for a tech platform that they're expecting this year, right? So
yeah, 350.
So they are on track to actually surpass it if it continues like this.
Which is interesting. Like if you were to criticize guidance at all beyond just like being conservative, which right now I think we're thankful for, was the tech platform. That's usually the one that they missed the mark on. So if they exceed that this year, that's nice.
Mm-hmm. Yeah, because he said 350 for the year, and we got 84 for the second quarter.
So that's 160 or something already right now.
Yeah, so 84 plus last quarter it was at
75 or so.
Yeah, 75. Which would bring it to 159.
Yeah.
Yeah, so 350. So 191 left. So we are expecting an acceleration in tech platform as well for the rest of the year.
He did say that the new clients are
That would
back
start.
half. Yeah.
And every quarter sequentially would be a little stronger. So
Let's take a look at lending segment. Jeez, man. This is a whole different story.
Yeah.
Wild.
Yeah. Net interest income for lending, 573 million, 724 total revenue for lending.
But the brand awareness just increased by 0.4% since Q1. So it was 10%, I think, in Q1. Now it's 10.4. So.
Oh, was it 10% in Q1?
Yeah.
Yeah. Lending platform, 312 million expenses. That was actually a big jump in expenses for lending. Any thoughts there, guys? Like, if you look at the expenses on all these other previous quarters, it was around 200 to 250 million. And then this one was over 300 million for expenses, meaning that the contribution margin is lower, 55, 56%.
But it is higher.
What's that?
No, it is at 50. We're 56, 55, 55. Okay, so it's flat.
Yeah, and if you look at 6 months ending, we're actually up.
Yeah.
Yeah. I mean, like year over year, it's flat. Last quarter, it went as high as 59.5.
Mm-hmm.
So I guess that was just like an outlier.
Yeah, that I wouldn't look too much into that. That could be super nitpicky for what they have to do on the background.
Mm-hmm.
Unless it's creating some sort of trend. I honestly, this looks fine. And
now we are trying to look at what went wrong, but we're just making things up that they're not really bad.
Overall, Sofi sold or transferred through our loan platform business more than 4.1 billion of personal loans and home loans. In terms of home loan sales, we closed 833 million at a blended execution of 101.6. They've been selling home loans on LPB before. It's just the first quarter I'm seeing it.
They don't sell home loans through LPB. LPB or home loans are sold similarly to LPB, but it's not actually financial services revenue. You would know that. He said that in our interview, Tevis.
No, but then how do you make this sentence then?
SoFi sold or transferred. I think it's SoFi sold or transferred through the loan platform business.
Oh.
More than 4.1 billion in total personal loans and home loans. That's not even 4.1 billion in LPB. That's just 4.1 billion in sold loans or transferred loans.
Yeah, some people are saying, hey, they're hoping to find anything positive. No, it's actually the opposite. It's like not hoping to find negative, but I think the biggest thing is the FOMC meeting. If you're going to report here, it's rate sensitive. It's really actually surprising that they raise guidance into this, which is you either have to look at as these guys are idiots or these guys know exactly what's coming. That even if they raise rates right here, they're like, yeah, we're going to beat, so we're going to guide accordingly.
I wish Chris could just join us and then tell us what's wrong with this report. Tell us why the stock is down. For those who don't recognize this name or are new to the channel, Chris used to do these calls with us, and then he got hired on by SoFi. So now he's working, with the team and can no longer join us. And we've lost a member, but not really. He's still part of the SoFi cult. He's just, we don't get to talk as much.
I mean, look, devil's advocate. This is all public knowledge now, so Chris can definitely point out the fine print that we're missing here.
If that's the way you see it, Chris, the link can always be sent your way.
Yeah, he probably shouldn't come on.
Yeah. Don't come on, Chris. Just
Your job security is in your hands, not mine.
yeah, this is a huge boost in personal loan products. 224,000 personal loan products quarter over quarter. And generally, they add between 100 to 150,000 quarter over quarter. So this is a big number here.
Yeah, it's wild to see this origination growth. Student loans up 170% year over year.
Yeah, let's go to financial services because that's the one I didn't see. Financial services. Yeah. Wow, big jump in the expenses for financial services.
What's that?
This one right here. It's a big jump.
46% contribution margin. I wonder what that is.
I mean, crypto, Sofi USD falls under this or no?
Chris? I would think it does. But and honestly, that might be it. If I could be very honest, I think this is the bear case, or the part that's going wrong with the thing is financial services has slowed way down.
Yeah.
And now you're telling me that the margin is not looking great either.
Yeah, just for context, like this would be what, 28% year over year growth? That's like lower than I think any of us are expecting. I mean, contribution margin still looks fine, 45%. It's slowed from recent quarters, but they came in at 45% last quarter too. So it's not that bad, but expenses are growing faster than the revenue's growing.
Yeah, I was expecting over 500, but at least it's not like last quarter. Okay, last quarter, we've had a drop quarter over quarter, mainly attributed to the non-interest income because they put more, they did less loan platform business than usual. This quarter, at least, we have an increase quarter over quarter as well, and it didn't dip even further down. So at least there is that.
I think, though, Neil, like this might just be deliberate on their part because they're just doing more of their own, through lending, of their own originations through lending, as opposed to loan platform. Like they can always crank this back up if they decide to sell more through loan platform business. I would think so. Yeah.
Yes.
Yeah. So here's the new SoFi Plus. They said in beginning of second quarter 2026, this is new. We updated financial services products to include SoFi Plus, which we relaunched during the quarter while fully transitioning the product to a paid subscription model, and Smart Card, I guess, is included in here. Our recently launched secured card. Oh, presented above within credit card. That's why credit card was 73,000 quarter over quarter, Tanner.
Understood.
Because they included Smart Card in there.
That's a lot of Smart Card, though.
Well, yeah, I guess we don't know how much how much was the normal credit card growth versus Smart Card. But yeah, and I would imagine like if it's the first time that they're including it, that you would get a big bump.
Yeah. But see, actually, no, you know what? Maybe that's fine. But there have been a couple of these tiny wins in products per member.
Mm-hmm.
SoFi Plus, well, it is a new revenue line, so I don't know. But really, the one that bugged me was SoFi Invest. So SoFi Invest went from tracking 2 different SoFi Invest products to tracking 4 different SoFi Invest products. That happened last quarter.
Yeah.
And so that big bump was just like, oh, okay, well, we don't really have more products per user. We already had those. But the way that SoFi breaks it down is a little bit different.
Yeah, 1.9 million new technology platform accounts. Which is like, I mean, look, it's not decelerating, or it's not declining. Let's put it that way. Because in Q3 and Q4 of last year, it was just like negative. But we'll see.
Yeah, no, I'm actually, I had much lower numbers on the tech platform, and when they launched these new clients, which onboarded last quarter, if it's a brand new product that their client is offering, it takes time to build that and fill out that revenue, and that's one of the reasons why usually quarter after quarter, when things go right, you don't have a massive client off board. You'll see that increase. So this is a really strong jump from the prior quarter. So I'll be interested to see if like third quarter we see another step like this. If so, things are actually going right after going horribly wrong on the tech platform for a while. So not a bad number at all.
Yeah. Yeah.
During the quarter, Sofi executed 2 co-contributor securitizations of loans previously originated through our loan platform business, totaling 1.4 billion. These mark the 6th and 7th securitizations of new collateral under the SCLP since 2021, using collateral originated in the loan platform business. This channel provides our partners with meaningful liquidity to support their ongoing investment in the loan platform business. More securitizations.
Okay. SoFi at Work still growing quite well. Relay is just an unbelievable product.
I mean, it's free, so.
I know, but it's what allows them to see insight into giving people a credit card, a home loan, a personal loan.
Mm-hmm.
You know, and I don't just mean that it's like, hey, it's doing well. I'm saying like it's doing better than it ever has. Like the growth rate is accelerating. I think that's pretty exciting. But yeah, I'm seeing a lot of like people in chat, really complaining about the stock price. I'm seeing things like, the Bears are winning and stuff like this. It's like if the stock was up 4%, you'd think that this quarter was great, and you're not just looking at the numbers and actually seeing like, hey, did this company get stronger or weaker during the past 3 months? And plus, we haven't even heard the quarter yet. Like we haven't heard the call.
And of course, the big thing is going again, because we had some people that joined us a little bit later. We have the FOMC meeting in 6 hours and 21 minutes. So
yeah. Hold the rate steady and then see the change in companies like SoFi stock on that reported news. Now, I will say the one thing about guidance being raised is that it didn't translate at all, not a dime, to adjusted EBITDA and net income. And so what is revenue if it means reduced margins? For real. Maybe future margin because you're getting more members onto the platform or something like this. But if you're paying $1 to get $1, is that a raised guidance or not?
Page 11. What's on page 11, guys? Everybody's saying page 11. Is there something in the disclaimers here?
I think maybe they're talking about the presentation.
It's the path generating ROTCE in the 20% to 30% range, but I don't think that's...
Net income margins will expand as businesses mature, and higher margin businesses are generally a larger part of the revenue mix. They've been around 30% while growing revenue more than 35%. Yeah, I mean...
Yeah, sweet.
Oh, Noto tweeted?
Probably the usual stuff.
I can bring it up.
Yeah. What did he say?
Notable point on tax rate going higher. We're pleased to raise our full year 2026 revenue guidance. Our fiscal 2026 EPS guide of 60 cents now includes an assumed full year tax rate of 22%. at the same mid-teens tax rate assumed in our original guidance.
So
Our
taxes
current-
are higher.
Our current EPS expectation would have been 65 cents, an increase of 5 cents. That makes me feel much better.
I mean, sure.
Well, it means that the revenue that they're bringing on through new members and all of these things after you pay your there's no amount of okay, we're not going to be able to or we're going to not pay our taxes this quarter. So tax rates don't bother me that much whenever a company has more expenses than they thought they would. Like Meta having to that one major, what was it, like $15 billion charge is like, what do you want them to do? Not pay their taxes? Like,
Yeah.
okay, well, you go do your situation, all right?
It's like, guys, domicile in the Cayman Islands, go through, Bermuda or Ireland or something.
You mean like new holdings?
Yes.
Okay, careful, Neil. All right, there's some shareholders on this call.
I am a shareholder as well.
Oh, well, smart lad. But yeah, we're talking about 40% revenue growth, 30% EBITDA margins, and people are like, "Oh, the Bears won again." It's like this is a bank with 70% rule of 40. Like, can we put this into perspective, please? Yeah, it's perfectly fine. The things are trending well.
The thing about the tax rate impact, I think we had this conversation 2 quarters ago at the end of 2025, maybe. And what's his name? Tim Sweeney? I think he made like a huge post about this at the end of last year, maybe when they raised money. Everybody was freaking out, and he said something about tax rate increases, etc., etc. I don't know. Maybe I'm making stuff up, but I'll try and find it.
It's not a
Yeah,
bank.
it's
Y'all
a-
need to chill. I gotta tell you something. It really is a bank. They got the license and everything. It's whether or not you take that as a bad thing is up to you. But I promise you, they are a bank. I know whenever they got their bank license, that's what that was the differentiating factor. Anything else that you're seeing, Tevis? Neil?
B-Dubs is saying, how does tax increase from mid-teens to 22%? Like, that's a big hike, I guess. I mean, I don't think that's their business, but you couldn't argue. It's something maybe Chris Hager can help us with. It's his department.
Is there anything written in the
Fine print.
fine print?
There's a guy at 743 that says it's a lower stock-based compensation windfall from a lower stock price at vesting dates. That might be a factor.
Let's see.
But honestly, if people are looking at this like, oh, the biggest thing that went wrong with SoFi is they have a higher tax rate. It's like, I mean,
Yeah, all right.
I'll take that. Yeah. Yeah. This is a report. It just looks like that they are seeing like, hey, there's a great opportunity here. Consumer looks really, really healthy. We're going to take advantage of it. We don't care what happens at the Fed meeting.
Income tax expense recognized in both periods, primarily attributable to profitability, partially offset by tax benefits for stock-based compensation in each quarter. What would you guys rather have? More stock-based compensation or more taxes?
I don't know.
I mean, I want them to introduce a new equity plan, man. Go to the board and say,
what like a
328.
performance-based
Yeah,
stock
absolutely.
comp?
Absolutely.
That actually kind of surprised me a bit with the annual meeting that they didn't do that. I figured old packages have gone off. They'll do something new. They'll make sure the incentives are aligned with shareholders. And it's fine that they didn't. They might just be saying, hey, now's not the right time. Reality is business is cooking, but the stock is cooked. So we'll wait until things are a little bit better and the shareholders would be more excited about this. Maybe. I don't know.
I honestly don't see anything here that would like freak me out. Like it's a pretty good quarter.
Yeah, I think the thing that we've gotten so used to sort of just like consuming the number and moving on is because we all guessed it right. But that we were roughly going to get 1.1 million new members. Let me get the exact number here. Yeah, we added 1.1 almost on the dot. But that's up from 1.05 and then from 1.0, from 900,000, from 830,000, from 780,000, from 750,000. Like it's just been a straight line, not in total members, but in member growth, right? And it's just something that we're just getting used to, but we shouldn't. This is a compounding business, and each one of those members are its own tiny compounder. They come back for a new transaction. They come back to put more deposits into their bank. They take out a loan. They pay that loan over multiple years. And the faster SoFi in its entirety is built up in a base of different products based on their members. And their members are growing faster than ever. The day that starts to really severely slow down in its growth rate, or God forbid it turns negative or something like this, the thesis on SoFi, part of it dies. But until that happens, these are the types of metrics that you look to and say, okay, well, that is continuously increasing. The margin that they're taking on 95% of these products continues to go up or stays flat. They're taking out more members, more products. And, if now what is being tested for you as a investor is your patience, well, honestly, if you can't handle it, sell your shares.
Yeah.
I don't know, man. I actually am pretty happy with this quarter.
Oh yeah. Yeah, I thought this would just be a checkbox quarter, nothing special. They'd be cautious because of the FOMC meeting, the uncertainty with Hormuz, inflation, and all that. Much, much better, much stronger quarter. Yeah, you can nitpick. Like that's the thing that usually happens when it's a really
guys, we're talking about tax rate.
Mm-hmm. Yeah, exactly.
Like
when it's a really good earnings and the stock is down, then you look for the reason. And I mean, like for sure, like tax rate, is certainly a factor. We can look at a few others, like we looked at personal loans being the primary driver. But man, you really have to kind of nitpick to find something negative. The reality is it's just the current macro with where we're at. But when you have all these different companies, not just SoFi, which SoFi, I didn't see comments on this, but I'm sure that we'll hear them in the earnings call, how healthy the consumer is, how great a time it is to be a lender, even with the rate uncertainty. Like all these companies are saying that. Some of the most conservative in the world. So
Neil,
what is there to be afraid of?
What are you thinking right now?
I'm reading a very long post from Tim Sweeney from January 28, 2025, where he talks about tax credits, taxes, lots of other stuff. So NOL carryover. So definitely we've had this conversation before. And again, it's higher tax rate is the reason why EPS is not higher despite revenue being higher. All the rest here for the quarter came in very good, actually. Again, we still have no earnings call yet. So we'll see what their reasoning is as to use the lending on the balance sheet way more than loan platform business. And yeah, I mean, all in all, this is still a company that's growing way faster than a lot of the companies in the market. Even tech companies might not be growing this fast right now. Of course, small base and all, but still, I if you remove the stock price or the stock reaction, everybody would say here, oh, amazing quarter, stock is probably up 5-10% or so after being down 40% year to date. So to me, I know some people say it in the comment section. I've said it before as well. It's a broken stock, not a broken company. People might compare it to a PayPal, but it's everything but a PayPal. A PayPal does not grow 40+%. So yeah, good quarter. Unfortunately, we have to look at the reasons why stock is down, and we've been talking about taxes for the last couple of minutes, which is not something I thought we would be doing. But hey, if that's the reason why, then I guess it's not a bad quarter.
Yeah, we'll learn about taxes, guys. Tim's listening to this right now. He's like, I got to do another update of this freaking post. I guarantee Tim's listening. I can't guarantee it. Anyway, call starts in 9 minutes. Who's buying more? Any
Today
interest
or
in
in
SoFi
general?
stock right now?
I mean, today is a big day. FOMC, then Meta, Microsoft, Robinhood, tomorrow Amazon, Apple, Reddit. I mean, it's a hectic
I see
day.
Chris in chat talk, maybe even 13. This guy can't have a positive take on
Can you
on
throw
anything.
Can you throw up other Chris's point? Chris Hager's point.
Q1 earnings transcript due to a
Given
decrease.
share price movement.
Sorry?
Given the share price movement.
So due to a decrease in the discrete tax benefits related to employee.
So
Yeah,
lower dilution, lower stock-based compensation, so a higher tax threshold.
But share price movement, is that just the PSUs didn't come through? Is that what that's saying?
Yeah, that's how I would read it. Most times you see it like...
Is that because it's July and like they were to expire in June, and so if they had reached $35 or $45, for example, the PSUs would have come through?
I think
I actually don't know when that would fall. I'd have to go through.
I don't know. I'm sure Chris Hager will let us know, but yeah, because if it was like, what if the stock was at $35 right now and we had unlocked the PSUs? How might that look? Because it would offset, wouldn't it?
I don't know. To be honest, I didn't even really hear what you said, but
Cool.
The silence just stayed too long. I thought I would answer. Okay, I'm still plugging numbers here. I will end up going through and actually creating, like, once we have the full numbers, this will probably be like after after 9 o'clock. I'll probably have everything done. But then again, I'll want to take notes and everything from the call. But everything looks fine, guys. Let's not be overreactors based on...
You should now insert this GIF. Everything's fine. And you're like in the middle of the room. Everything's burning.
Yeah. The dog.
Yes.
Yeah. The total share count is climbing. I don't know. They won't do buybacks though. I don't believe so. I think they'll just take that money and throw it into more loans over time.
Here's the share count, just in case somebody was curious. Let me move the EPS. It's up, a little bit, but relative to where we would have been if all those PSUs had landed, not nearly as much as you might expect. So the biggest increases were, of course, with the equity raises going back to December. This big step forward, and the earlier earnings as well. So yeah, it is higher, than it was last year, but that rate of acceleration is certainly not there, especially with where the stock price is.
Yeah, I was looking year over year, so It looked much worse that way.
Yeah.
And I mean, if the PSUs were hit, we would have been much higher than $16 right now. So
Yeah. Yeah. If
wouldn't
we were trading
mind.
at $48 a share, nobody would be worried about SBC.
Exactamundo.
Okay, let me make sure I got this call up. See if Anthony can drop some bombs for us. That being said, though, I know a lot of people, like to listen to the intros and outros from Anthony, but really pay attention to what Chris has a lot of the time and try to look through to some of the stats that he gives, because some of the times he gives the most I don't know how to say it, but some of the words that he says are most affecting the stock than even what Anthony is saying, because he can say whether or not that their loans are performing very well or underperforming or something like this. And I think that's also what's bothering Wall Street a little bit right now, is also that they haven't been selling personal loans, and so they can't actually mark them efficiently. That was another thing too in one of the slides that we could take a look at here. Let me bring that up. So we got the pleasure of speaking with investor relations last quarter, and one of the reasons why this dot here that signified whether or not what they were marking the fair value marks for their personal loans at versus what they were selling them at was always much higher. Now, the fact that there's not two dots here for Q1 and Q2 is not because they're underperforming. It's just because they haven't sold a thing. Now, some bearish analysts would point that to the reason why they're not selling anything is because it would be lower than their fair market values. And now that this rate is starting to point downward, maybe you could actually highlight that a little bit more. But until we have any of that data, anything else is speculation. And the fact that they're doubling and tripling down on loans makes me feel that they're pretty confident on the performance of their loans right now.
Yeah, last quarter we had the remark that they had more opportunity to sell loans in the loan platform business, as far as what their clients were willing to accept, and they're like, nope, we want those. They're accretive for us. So I expect that we'll probably get similar comments as well this time. Love to get there's a little bit of an update on big business banking, but it's mostly just saying, hey, we launched. Would love to get a update on that too if they have that.
Where would that even fall? Would that fall in financial service? Like, where would the revenue from that even fall?
I think it probably breaks down into what's the financial services of big business banking and what's the lending. But I don't expect that they're going to be doing big business lending right now. So financial services for the USD and the subscriptions and the payments and stuff, it's probably all financial services. It's actually one of the questions that I had. I said, if you guys are going to be getting into big business banking or small business lending or something like this, are you going to break out into like another segment of the company? And they said, we have no plans for that right now. Okay, call is starting here in 1 minute. Stock is currently sitting at $16.13 in the pre-market. Very, very pre-market. So we'll see how that changes as the call progresses, and then potentially what that looks like at 9:30 whenever the market's open.
And then again with the FOMC meeting, if they, with a third of people expecting a hike today, if that doesn't materialize, Sofi and a lot of the market will probably be pretty green depending on the comments.
Okay, we got 10 seconds here. Any last words from Neil?
Last words? No, good quarter. People should smile a bit more. Look at the results, look less at the stock, and should be good to go.
This is not a lack of a smile because of the stock.
It's
This is
tired
a-
and hungry.
It's, yeah. It just turned 8 a.m. That's what it is. I didn't even check my sleep score. By the way, the call, okay, starting right now. Enjoy, everyone.
Second quarter 2026 earnings conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, simply press star followed by the number 1 on your telephone keypad. If you would like to withdraw your question, press star followed by the number 1 again. Thank you. With that, you may begin your conference.
Thank you and good morning. Welcome to SoFi's second quarter 2026 earnings conference call. Joining me today to talk about our results and recent events are Anthony Noto, CEO, and Chris Lapointe, CFO. You can find the presentation accompanying our earnings release on the investor relations section of our website. Unless otherwise stated, we'll be referring to adjusted results for the second quarter of 2026 versus the second quarter of 2025. Our remarks today will include forward-looking statements that are based on our current expectations and forecasts and involve risks and uncertainties. These statements include, but are not limited to, our competitive advantage and strategy, macroeconomic conditions and outlook, future products and services, and future business and financial performance. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release and the subsequent 10-Q filing, which will be made available next month. Our actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are described in today's press release and our subsequent filings made with the SEC, including our upcoming Form 10-Q. Any forward-looking statements that we make on this call are based on assumptions as of today. We undertake no obligation to update these statements as a result of new information or future events. And now I'd like to turn the call over to Anthony.
Thank you and good morning, everyone. I'm pleased to share that we had nothing short of an exceptional quarter. Q2 was our 19th consecutive quarter exceeding the Rule of 40 with a score of 70. This included exceptional revenue growth of 40% year-over-year and a 30% EBITDA margin. Our team has continued to execute at a remarkable level, and our business mix has proven its durability, driving record growth and profitability in the face of a volatile interest rate environment. Few businesses have maintained such a strong combination of growth and returns for what has been nearly 5 years, and it still feels like we're just getting started. Our success is driven by our focus on building innovative products that are far superior to what is available from traditional banks and fintechs alike. Our members recognize this, and as their needs grow, they take out additional products and become our greatest advocates. This in turn fuels our growth and financial performance. Despite our significant scale, our growth has not slowed. We added a record 1.1 million new members in Q2, increasing total members 35% year-over-year to a total of 15.8 million members. To put this in context, we had 650,000 total members when I joined in 2018, and we are now adding that amount every 7 or 8 weeks. We also, for the first time, added twice as many products as members, despite having such rapid growth in members. We added a record 2.2 million new products in Q2, increasing total products by 42% year-over-year to 24.4 million products. This is a huge milestone for our Everything app strategy as more members take out multiple products, driving our competitive advantage and having a superior lifetime value. In fact, we've reached an important inflection point with products per member accelerating over the last 2 quarters. We are starting to hit escape velocity on our path to be the winner that takes most in digital financial services. Cross-buy continues to accelerate with 51% of new products opened by existing SoFi members. This is up from 43% last quarter and 35% in Q2 of 2025. That's a year-over-year increase of 16 percentage points. This is a reflection of the trust members have in SoFi and the superior products we are building, which work better together and are designed to promote further cross-buy. Two of the clearest examples of our unique ability to package all that we offer into uniquely differentiated products are SoFi Plus and SoFi Coach. Both are only possible because of our diverse set of products and services, and their usage drives cross-buying that powers our financial services productivity loop. SoFi Plus is our premium membership offering that brings the best of every SoFi product into one experience with a value that is unrivaled in the market. At the start of the second quarter, we relaunched SoFi Plus with significantly enhanced benefits in each of our products. For example, SoFi Money at 4.5% interest and SoFi Invest with a 1% match, while fully transitioning the product to a paid subscription model. The results have exceeded our expectations. After just one quarter, we surpassed 200,000 paid subscribers, with most of the growth coming from existing members who are upgrading their memberships. This equates to an annualized revenue of over $24 million. Importantly, we're seeing incredibly strong cross-buy. 85% of new SoFi Plus members were existing members, and 25% of those are adding another product after Plus, with SoFi Invest accounting for the highest percentage of the follow-on demand. For new to SoFi members who join via SoFi Plus, SoFi Money is the main product that is subsequently being adopted. And across both groups, we're seeing very strong adoption of SoFi Relay and our lending products. SoFi Plus is doing exactly what we designed it to do. It's creating a recurring revenue stream. It's increasing awareness of the breadth of products in our Everything app. It's driving greater cross-buy, as well as increasing deposits, spending, and AUM in the existing open accounts, all in hand increasing member lifetime value. It's the financial services productivity loop in action. We are encouraged to see the success so far, and I'd be disappointed if we are not at 1 million SoFi Plus members generating annual revenue of $120 million a year from now. That same strategic focus on deepening member relationships is behind SoFi Coach, which launched in June. SoFi Coach brings together three things no other company can: the full picture of a member's personal finances across their SoFi products and third-party products, the trust and security of a regulated bank, and soon, the ability to perform actions on behalf of our members. The result is personalized financial guidance across a member's entire financial life that helps them achieve the most critical success factor on their way to realizing their ambitions, which is spending less than they make and investing the rest. A key driver of Coach's success is our unique data set from both our breadth and depth of products, services, and activities. Coach is powered by SoFi Relay's hub of financial data that spans 12,000 connected financial institutions, 6.5 billion transactions, roughly $750 billion in outstanding balances, and over $250 billion in member real-world assets. This unique data set gives SoFi Coach an amazing level of insights on which to base its responses to members' financial questions and soon-to-be proactive insights to what members can do. Since Coach's rollout, we've already seen nearly 500,000 conversations with over 90% positive feedback. Every interaction with Coach gives us real-time insights into what matters most to our members, what they need, and where we can help them the most. For example, more than half of the conversations to date have focused on investing. We believe we can uniquely help the nearly 65% of Americans over the age of 18 that do not buy stocks, ETFs, or invest in robo accounts become great investors. This is just the beginning for Coach, and we'll continue to expand its capabilities. One of my favorite questions to ask is how much I've spent on subscriptions in the last month. Suffice it to say, I'm astonished by how many subscriptions I pay that I no longer need. I cannot wait for our launch of automated subscription management and cancellation coming later this year. SoFi Plus and Coach are exactly the kinds of products that make our model more powerful over time. They help members get their money right across their entire financial life. They deepen engagement across the platform, and they create more opportunities for cross-buy, resulting in more lifetime value that we can reinvest in better interest rates on checking and savings, better interest rates on tokenized deposits, higher matches on contributions to your invest account, lower interest rates on home loans, personal loans, and student loans, and better services like free certified financial planners. The durable and consistent 35% growth in our members and the inflection point in products per member and cross-buy that we've seen in the last 2 quarters are a direct result of these 2 everything products in our Everything app driving the financial services productivity loop, and we could not be more excited about our strategy and execution coming together as we pull away from the industry. With that, let me now turn to the second quarter results. In Q2, adjusted net revenue was ahead of expectations and up 40% year-over-year to $1.2 billion. Importantly, our revenue growth continues to be durable and diversified. Total fee-based revenue was $472 million, representing 39% of total revenue in the quarter. This is an increase of 22% from last quarter and up roughly 38% year-over-year when normalizing SoFi Technology Solutions, or STS. The growth was driven by origination fees as well as strong performance from our loan platform business, interchange revenue, brokerage fee revenue, and SoFi Tech Solutions revenue. In the second quarter, we generated $1.2 billion in cash revenue. This was our 3rd consecutive quarter of generating over $1 billion in cash revenue. Our lending segment had another very strong quarter, generating a record $712 million in adjusted net revenue. In total, we had our best quarter ever for loan originations at $14.8 billion, which was up over $2.5 billion from just last quarter and included record originations across personal, student, and home loans. This was our first $10 billion quarter of personal loans. Of the $14.8 billion in total originations, $11.7 billion was for our lending segment and $3.1 billion was for our loan platform business. The diversification across channels demonstrates the strength and optionality that comes from having a fortress balance sheet and strong demand from our capital markets partners. Similar to Q1, we are balancing loans originated for our balance sheet with loan platform business originations to drive both returns and great visibility of net interest income for the next 6 to 8 quarters. Loans originated for our balance sheet are providing a competitive advantage in a large, durable, and highly visible revenue stream with attractive returns, which is allowing us to make massive investments relative to our digital competitors. For example, from Q1 2024 until Q2 2026, we have generated $5.4 billion in cash net interest income, which has allowed us to make significant investments to launch new businesses and drive high rates of growth in both members and products. Additionally, the net interest income recorded of $5.4 billion is 2.7 times the cumulative non-cash premium on our balance sheet of $2 billion. So not only is the scale of net interest income revenue an advantage, we are delivering significant returns compared to the original marks recorded in our non-cash revenue. Together, our financial services and technology platform segments generated revenue of $551 million, representing 46% of adjusted net revenue. Over time, we expect these revenue streams to be more than 50% of our revenue and a key driver of our long-term target return on tangible common equity of 20 to 30%, which is now becoming very visible. In addition to delivering durable growth, we've delivered strong returns and profitability. In the second quarter, adjusted EBITDA was $358 million, up 44% year-over-year. Our adjusted EBITDA margin for the quarter was 30%. Our incremental EBITDA margin was 31% as we continue to balance reinvesting in the business to drive long-term growth and balancing profitability. Adjusted net income in the quarter was $160 million at a margin of 13%. Adjusted earnings per share were 12 cents, which included a negative impact of roughly half a penny due to higher than expected tax rate. Finally, our tangible book value ended the quarter at $9.5 billion, up 80% year-over-year, and $7.34 per share, which is up 56% year-over-year. Let me now turn to brand building and additional product innovations across our business. In the second quarter, unaided brand awareness rose to an all-time high of 10.4%, up 190 basis points year-over-year. It was another exciting quarter. We saw SoFi brand ambassador Wyndham Clark win the U.S. Open at Shinnecock. We brought together some of the biggest names in country music for CMA Fest presented by SoFi, reaching millions of viewers across ABC, Hulu, and YouTube. SoFi Stadium welcomed the world as host to Team USA in several FIFA World Cup knockout round matches, putting the SoFi brand on one of the biggest stages in global sports. And just yesterday, we announced a multi-year partnership with Notre Dame Athletics, becoming the first brand to appear on the Fighting Irish jerseys across all 26 varsity sports. In football, Notre Dame is in a class of one as the only Division I program with their own broadcast television media deal, giving them a national television audience for primetime games that is well above the average for 95% of primetime professional and college sports. Similar to the SoFi Stadium deal, SoFi will be seen by millions of unique television viewers each week. Turning now to our product innovation. 87% of our products, or 21.3 million total products, are now non-lending products. These include SoFi Money, SoFi Relay, SoFi Invest, SoFi Credit Card and Smart Card, SoFi Crypto, SoFi Protect, SoFi Plus, and recently launched SoFi Big Business Banking. These products are more broadly appealing, are used much more frequently, and have vastly lower customer acquisition costs than our lending products, and as such, put the sword in member acquisition that fuels our downstream loan originations via cross-buy at superior customer acquisition costs. The breadth and depth of our product ecosystem and the scale we've achieved with 21.3 million non-lending products that members engage with regularly will increasingly strengthen our competitive advantage and drive long-term growth in a way few financial services companies can match. Here are a few highlights. Our Invest products grew 38% year over year, while brokerage revenue increased nearly 2.5x. That reflects both growing engagement and stronger monetization. We know savings get you by, but investing gets you ahead. Savings alone won't get members to their financial goals. They also need to be investing for the long term. Yet 65% of Americans still don't invest. Our goal remains to make investing simpler and more accessible by giving everyday investors access to the best tools and opportunities which they have not historically had. For example, during the second quarter, we brought AI to SoFi Invest with the launch of Composer by SoFi. Composer lets members turn investing ideas written in plain terms into strategies they can build, test, and automate in minutes. It is simple, intuitive, and accessible, fitting perfectly into the SoFi Invest platform. In June, we also gave members access to the record-setting SpaceX IPO, which became the largest and most subscribed IPO offering in SoFi's history. It was our 36th IPO offering over the past 5 years. This year alone, we've completed more IPO offerings than in all of 2025, and we're excited about the pipeline of companies that may go public this year. Just this month, we launched SoFi Social 50 Income ETF, which gives investors exposure to an options-based income strategy without having to build and manage covered call positions on their own. This fund combines the 50 most widely held stocks across SoFi self-directed brokerage accounts with an actively managed option strategy seeking monthly income and long-term growth. Now let me spend a minute on SoFi Credit Card. We think we've cracked the code on efficiently acquiring high-quality credit card members. Year over year, credit card revenue has more than doubled. In fact, credit card revenue is up nearly 50% and products are up 17% from just last quarter. We're excited by the trends we are seeing, not only in the back book, which reached profitability, but also our ability to add the right members in this important product. Turning now to crypto and big business banking, where we're building the infrastructure to bring blockchain-based financial services to consumers and businesses alike. We have been pioneers in this space, becoming the first nationally licensed bank to launch crypto trading and our own stablecoin in SoFi USD. In the second quarter, we began settling our trading business in SoFi USD, and in big business banking, we began processing transactions on the SoFi Exchange network, enabling our first commercial clients to move money in real time 24/7. This marks an important milestone for two reasons. First, it creates more real-world commercial use cases for SoFi USD, helping to scale our new lower cost, faster and safer proprietary payment rails. And second, it significantly expands our enterprise offering for SoFi Technology Solutions, creating new opportunities for both fee-based revenue and net interest income over time. Big business banking clients can now hold funds in regulated insured business deposit accounts, move money and digital assets in real time through API-driven payments, and seamlessly convert between fiat and digital assets, all within SoFi's regulated banking environment. We first announced Big Business Banking in January, and just months later, it's already in market and serving commercial clients. That speed of execution reflects both our culture and the capabilities of the SoFi Technology Solutions cloud-native banking core on which Big Business Banking was built entirely. Big Business Banking isn't the only powerful proof point for SoFi Technology Solutions, or STS. We've begun onboarding SoFi Money to our new, modern, cloud-native banking core, fully developed by STS and purpose-built for U.S. regulated banking environments. The platform will soon be available to other banks, financial institutions, and brand partners. This marks the first major U.S. bank to join the platform, serving as a proof point for other large U.S. institutions who want to modernize their infrastructure to meet the demands of the evolving financial landscape. We're also accelerating SoFi Technology Solutions capabilities. During the quarter, we acquired Peach Finance, adding new platform services across credit card, lines of credit, buy now, pay later, and installment lending. The acquisition strengthens our offering for banks, credit unions, fintechs, and enterprise clients, while also positioning us to bring SoFi's own credit card processing in-house and launch a full-stack revolving credit card platform for our clients. Turning now to innovation with our lending products. Since 2024, we've been referring members to small business lenders through our online marketplace. But recently, we identified an opportunity to serve these folks directly with a SoFi small business loan. Entrepreneurs and small business owners are the backbone of our economy, yet they are not well served. On one hand, you have banks and credit unions that are not providing the necessary access to capital or doing so at a snail's pace. And on the other hand, you have newer entrants that are charging exorbitant rates. Our new small business loan combines competitive pricing with the speed and simplicity members expect from SoFi, helping us serve more of our members' financial needs seamlessly on one digital platform. We are starting off by originating SMB loans through our loan platform business to establish partners. In the future, we may also create optionality to hold these loans on our balance sheet to generate recurring net interest income. In the second quarter, we also launched our new home equity line of credit experience, giving members fast access to a revolving line of credit right in the SoFi platform. Unlike most lenders, SoFi offers both home equity lines of credit and home equity loans, allowing us to match members with the right solution while providing a lower cost alternative to unsecured loans, and all with the speed and simplicity members expect from SoFi. Together, these products accounted for 1/3 of our record home loan originations during the quarter, helping drive growth as purchase and refinance remain muted in this high-rate environment. We had an amazing quarter on any measure. Our exceptional member and product growth continue to demonstrate the trust and confidence that our members have in the quality of our products that keeps them coming back for more. Our offering is unmatched across traditional banks, fintechs, and everyone in between. We continue to make significant investments in our platform, adding new products like SoFi Coach and making existing products like SoFi Plus even better. These investments reinforce what makes SoFi different, a seamless, integrated experience that helps our members do more with their money all in one place while advancing our mission to help people get their money right. Our execution has led us to an important inflection point in our strategy and results. As our member base grows, cross-buy increases, and engagement deepens, the power of our financial services productivity loop continues to compound. That flywheel is driving higher quality, more durable earnings, and positions us to achieve our long-term target of 20 to 30% returns on tangible common equity. We are building a financial services company with a business model that we believe is increasingly differentiated, increasingly profitable, and increasingly difficult to replicate. With that, I'll turn it over to Chris.
Thank you, Anthony. We had a strong second quarter and have great momentum heading into the back half of 2026. Our innovation and brand building continue to power exceptionally strong revenue growth. In the second quarter, adjusted net revenue grew 40% to $1.2 billion. Importantly, we generated $1.2 billion in cash revenue in Q2, our third straight quarter exceeding $1 billion of cash revenue. This included $790 million from net interest income and approximately $420 million from interchange fees, brokerage fees, technology platform fees, loan platform fees, and loan origination fees. Cash is defined and accounted for the same universally, no matter what type of company it applies to. In addition to our strong revenue growth, we delivered strong profitability during the quarter. Adjusted EBITDA was $358 million, up 44% year over year at a margin of 30%. Adjusted net income was $160 million at a margin of 13%. Net income was up 61% year over year. And adjusted earnings per share was 12 cents, which included a negative impact of roughly half a penny due to a higher than expected tax rate. This was our 11th consecutive profitable quarter. Turning now to our segment performance, starting with financial services. For the second quarter, financial services net revenue was $466 million, up 29% year over year. Contribution profit was $213 million, up 13% from last year. And contribution margin was 46%. Net interest income for this segment was $249 million, up 29% year over year, which was primarily driven by growth in member deposits. Non-interest income grew 28% to $217 million for the quarter. During the quarter, we achieved record interchange fee revenue, which was up 67% year over year and 25% from just last quarter. This was driven by more than $28 billion in total annualized spend across money and credit card. We also achieved record brokerage fee revenue, which was up 2.4x year over year and 20% from just last quarter. During the second quarter, our loan platform business generated $143 million of revenue, driven by the $3.1 billion of personal loans originated on behalf of third parties, as well as referrals. This includes $2 million of servicing income recognized in our lending segment. Our loan platform business helped us achieve another quarterly record in total personal loan originations of $10.7 billion, meeting incremental demand from our members beyond what we would put on our balance sheet. Note that during the second quarter, we had significant demand from LPB partners over and above what we decided to fulfill, but we did fill all demand from our contractual commitments and more. We have also recently made several positive advancements with our loan platform business. First, we've reached an agreement with a new partner, Sixth Street, to invest in personal loans totaling up to $1 billion. Second, we've expanded our offering to include our new SMB loan product and have agreed to terms on a 3-year, $3 billion agreement with Base Point Capital. Third, we've just further expanded our offering to include our home equity loans, with the first loans being transferred in the coming days to a leading global bank. Adding 2 new loan types to the loan platform business is a significant achievement that will not only provide opportunities to grow our capital-light fee-based revenue, but it will also allow us to serve more members, generating more cross-buy over the long term. LPB is a great example of how we can build highly scalable, tech-driven platform businesses. Shifting to our tech platform segment. For the second quarter, we delivered net revenue of $85 million, up 13% from the prior quarter. Contribution profit was $12 million at a contribution margin of 14%. Revenue growth was driven by further monetization of existing clients, as well as contributions from new clients. Turning to our lending segment performance, which was very strong during the quarter. For Q2, adjusted net revenue for the segment was $712 million, up 59% from the same period last year. Contribution profit was $399 million, with a 55% contribution margin. These strong results were primarily driven by growth in net interest income, which increased 54% year over year to $573 million. The balance of the growth came primarily from loan origination fees, which were up 64% year over year. During the quarter, we saw continued record member demand for our lending products. For personal loans, we delivered record originations of $10.7 billion, of which $7.6 billion was originated for our balance sheet. The ability to hold loans on our balance sheet is a key differentiator for SoFi, allowing us to generate predictable, recurring, net interest income, and to efficiently deploy our capital to generate strong risk-adjusted returns. For example, our core personal loan product generated a roughly 6.1% risk-adjusted margin in Q2. This consisted of a weighted average coupon of 12.9%, a funding cost of 3.1%, and annualized losses of 3.7%. Our ability to generate loans with attractive risk and return profiles supports our strong revenue growth through both balance sheet lending and our loan platform business. In addition to the record personal loan originations, we also saw record originations in student and home loans. Student loan originations were $2.7 billion, up 2.7x from the same period last year. Home loan originations were $1.4 billion, up 74% from the prior year. Turning to capital markets, where activity continued to be strong in the second quarter. During the quarter, we transferred $3.1 billion of personal loans through our loan platform business. We also closed $834 million in home loan sales at a blended execution of 101.6%. Consistent with prior quarters, we sold $90 million of late-stage delinquent personal loans. In addition to these loan sales, we executed 2 securitizations of loans originated on behalf of our partners through the loan platform business, totaling $1.37 billion. These transactions priced at an industry-leading cost of funds levels with weighted average spreads of 91 basis points and 86 basis points, respectively. In fact, 86 basis points was our best ever pricing, reflecting exceptional demand for SoFi-originated loans. I would also note that our most recent deal was meaningfully upsized from the original deal size. Turning to credit performance. Our credit performance remains very strong overall, performing in line with our expectations and driving attractive returns across all loan types. For personal loans, we saw a very strong credit performance during the quarter. Excluding the impact of delinquent loan sales, the estimated all-in annualized net charge-off rate was 3.7%. This 70 basis point decrease from last quarter was driven by an improvement in the underlying credit performance as well as growth in average loans on the balance sheet. Including the impacts from the DQ sales, the net charge-off rate was 2.62%. This is down 41 basis points from the first quarter and 21 basis points from the second quarter of 2025. The on-balance sheet 90-day delinquency rate was 40 basis points, down 7 basis points from last quarter. For student loans, the annualized charge-off rate was 61 basis points, down 4 basis points from the prior quarter. The on-balance sheet 90-day delinquency rate was just 11 basis points, up 1 basis point from the prior quarter. Turning to our fair value marks and key assumptions. As a reminder, we mark our loans at fair value each quarter, which is done alongside an independent valuation specialist. This is based on actual loan level data and considers a number of factors, including the weighted average coupon, the constant default rate, the conditional prepayment rate, and the discount rate comprised of benchmark rates and spreads. At the end of the second quarter, our personal loans were marked at 104.7%, down 71 basis points from the prior quarter. This was driven by an increase in the discount rate, which was up due to higher benchmark rates, as well as a modest increase in the default rate and prepayment rate assumptions, and a small decrease in WAC. At the end of the second quarter, our student loans were marked at 104.4%, down 85 basis points from the prior quarter. This was driven by an increase in the discount rate due to a higher benchmark rate, partially offset by a modest decrease in the prepayment rate. The WAC and default rate assumptions remained relatively consistent with the first quarter. Turning to our balance sheet. In the second quarter, total assets grew by $7.2 billion. This was driven primarily by $5.8 billion of loan growth and roughly $800 million of growth in cash equivalents, and investment securities. Total company-wide cash at quarter end was $3.6 billion. On the liability side, total deposits grew by $5.3 billion to $45.5 billion, which included strong growth in member deposits. Our net interest margin was 5.98% for the quarter, up 4 basis points sequentially. This included a 7 basis point increase in average asset yields, partially offset by a 1 basis point increase in cost of funds. We continue to expect a healthy net interest margin above 5% for the foreseeable future. In terms of our regulatory capital ratios, we are very well capitalized. Our total capital ratio of 18.8% at quarter end is well above the regulatory minimum of 10.5%, as well as our additional internal stress buffer. Over the medium term, we expect to efficiently deploy our excess capital into high-returning assets while letting our risk-based capital ratio normalize toward the low to mid-teens. Tangible book value grew $4.2 billion year over year to $9.5 billion. The tangible book value per share at quarter end is $7.34, up from $4.72 a year ago, a 56% increase. Let me finish by providing our outlook for the year and some longer-term thoughts. In line with market expectations, we now expect an interest rate outlook consistent with the Fed funds futures and 1 to 2 hikes in 2026 versus the expectation of 2 rate cuts when we first provided our 2026 guidance. Now for our specific guidance. For the full year 2026, we now expect to deliver adjusted net revenue of $4.75 to $4.85 billion, which equates to year-over-year growth of approximately 32 to 35%. This is up from our prior guidance of approximately 30% year-over-year growth. We continue to expect to deliver adjusted EBITDA of approximately $1.6 billion, which equates to an adjusted EBITDA margin of approximately 33 to 34%. Adjusted net income of approximately $825 million, which equates to a net income margin of approximately 17%. And the EPS of approximately 60 cents. Our EPS guidance now includes a tax rate of 22%, which is approximately 700 basis points higher than our original guidance. At the same mid-teens tax rate as our original guidance, our new guidance today would have actually been 65 cents in EPS instead of our actual guidance of 60 cents in EPS. As we look out over the longer term, we are on a path to generating returns on tangible common equity in the 20 to 30% range. ROTCE is the product of net income margin times the amount of revenue generated per dollar of tangible equity. For example, a 25 to 30% net income margin combined with approximately $1 of annual revenue for every dollar of tangible common equity produces roughly a 25 to 30% ROTCE. Achieving both a net income margin of 25 to 30% and the revenue of equity ratio of 1 is embedded in our strategy with a very visible path from where we operate today. First, we expect continued expansion in the net income margins due to both higher margin businesses becoming a larger part of our mix, and we continue to realize operating leverage. Second, we're increasingly generating more revenue without a commensurate increase in equity by growing more capital-light fee-based businesses. We have high visibility and confidence in our target net income margin because our incremental net income margin has already been approximately 30% while growing revenue more than 35%, demonstrating that these margin levels are achievable. As the business matures and incremental margins increasingly become overall margins, we believe the path to a 25 to 30% net income margin is highly probable. Revenue to equity is a function of revenue mix and capital efficiency. We believe both of those outcomes are achievable over time through execution of the strategy we're already pursuing, which is why we have confidence in our long-term return profile. Overall, Q2 was a strong quarter, and we continue to have strong momentum in our business. Let's now begin the Q&A.
At this time, I would like to remind everyone, in order to ask a question, press star, then the number 1 on your telephone keypad. Please keep in mind we'll take only one question per person at a time. Please rejoin the queue for any additional questions. Thank you. Your first question comes from Devin Ryan with Citizens Bank. Your line is open.
Thanks. Good morning, Anthony and Chris. And first off, congratulations on the Notre Dame partnership, my alma mater. So good to see that yesterday. You got a lot of attention. Question just on loan platform and really want to focus on some of the new capabilities with SMB and home equity and the new agreements that you guys have recently announced. can you just give a little bit of context around the capacity that you see in kind of some of these newer categories, and also how quickly SoFi can build origination volume into that capacity, and just also how we should think about kind of the fee economics in these new categories as you kind of expand beyond personal loans? Thanks.
Yep, absolutely. Thanks, Devin. So in terms of loan platform business, that was originally started a few years ago, primarily as a referral channel where we were sending all of our declines to a marketplace and generating a fee. That evolved over time to where we started to originate on behalf of others in meaningful scale from an unsecured personal loan perspective. I would say, and I've said this consistently, the nirvana state for the LPB business is to be able to go to investors with a menu of options and asset types that allows them to pick and choose exactly what they would like from both the risk and reward and return profile perspective. And one of the key things that we needed to achieve was to start expanding the loan platform business into other asset types. And this is the first quarter where we were able to do so by introducing the SMB partnerships. There are two of them. One is with Base Point Capital for $3 billion over 3 years, and the other is with an undisclosed party for several $100 million. And then we are also introducing home equity lines of credit to the mix as well in the coming days. In terms of the overall size and scale and opportunity and our ability to originate into that, we're just starting to originate in meaningful scale on the SMB side. There's considerable demand from an application start perspective, and you would expect to see economics in the range of where we're executing today to maybe slightly better. On the closed-end seconds and mortgage side, similar story. We're already originating at a pretty good clip right now on a monthly basis, and the partnerships that we're talking about are in the $100 to $200 million per month, but we're talking to several parties. But we certainly have the ability to originate into that. And again, from an economics perspective, we don't disclose that by party, but you could expect it to be similar to where we're executing today.
And the other thing I would add is that as we continue to build out a more diversified portfolio of loan platform businesses, we build new relationships that can benefit existing loan platform businesses. The SMB business is one that we think we can be incredibly competitive on. Similar to personal loans and credit cards, most SMB lenders are charging exorbitant rates of over 30%. We think we can operate meaningfully below that and take significant market share. If you think about our portfolio of loans and originations more broadly, we are really taking massive market share from high return, high profit margin types of products. So in personal loans, we're underwriting WAC at about 12% compared to credit card at 25%. That's an incredibly compelling value proposition for any individual consumer. In SMB, as I mentioned, we could be 10 or points below where the pricing is on SMB. Closed end, also, we can be more competitive than others. And because we're more competitive on price, we get higher quality borrowers, which will only reinforce the productivity loop of originating high quality borrowers, delivering great return assets to our partners, putting great return assets on our balance sheet, driving capital that can continue to fund that. And we're very close to that whole equation playing out.
Your next question comes from Andrew Jeffrey with William Blair. Your line is open.
Thank you. Good morning. Great to see the momentum you have in the business. Anthony, kind of a high-level question for you. I know the company has been sort of hyper-focused on driving members given the size of the TAM, and now it seems that cross-buys reached a pretty important inflection point. Is this the time to sort of focus on monetization sort of at the margin versus member growth, or do you think you walk and chew gum and we see both metrics rise over the next couple of years?
It's an important point that you bring up. It was an important inflection point for us in this quarter. It started in Q1. We didn't want to overemphasize in Q1 relative to Q2, but make no mistake about it. This is the first half of this year has proven that our broad-based everything app strategy is working. We've seen improvement in products per member in Q1 and Q2. We continue to expect that to happen for the foreseeable future. We have the right portfolio of products where people are organically acquiring the next product. And so if you think about Relay and you think about SoFi Money, those are tip of the sword products that are broadly appealing. We have over 7 million Money members now, over 6 million Relay members. The more Money members we bring in, the more Relay members we bring in, the more downstream benefit we get in SoFi Invest and SoFi Credit Card and SoFi SMB, as well as all the loan products. And those acquisition costs are basically zero on those other products, which basically doubles the profitability on the loan side. And so there's a great flywheel here at work. And what's changed this year is that the SoFi Plus product, the SoFi Crypto product, are absolutely driving product per member organically. So as we mentioned in the remarks, SoFi Plus relaunched. We're already at over 200,000 paying members, which is on a run rate basis going to be over $24 million a year, and it's growing very rapidly. But the most important thing is that 85% of those new SoFi Plus members are existing members. And a quarter of them are taking out another product after they take out SoFi Plus. So if an existing member takes out SoFi Plus, they have at least 2 products since they're existing, and then 25% of them are taking out another product. Layer on top of that, more broadly appealing products like crypto and more broadly appealing products like SMB and now big business banking, and you can see the flywheel really working. So our growth is going to be driven by members, by products per member, and by revenue per product. So all three working for us, and you saw that in the quarter.
Your next question comes from John Hecht with Jefferies. Your line is open.
Hey guys, good quarter. Thanks very much for taking the question. Anthony, I'm wondering if maybe you can give us an update on the competitive, the competitive environment and like customer acquisition costs and channels, and how are those trends going?
Yeah, outside the loan business, the competition is very benign. Our customer acquisition costs are staying pretty stable. The team's doing a great job of really optimizing unit economics and driving efficient scale and customers. The fact that we're driving 35% year-over-year growth in members and over 40% growth in products and really keeping CAC constant is a function of the great data analytics we have and the value prop that we have. Each one of our products, we absolutely designed to be the best of breed on its own, both from a value prop to the consumer as well as unit economics. So we're indifferent in what product they take first. But we're seeing continued strong demand in our channels at stable pricing in all of the financial services products. The lending products are definitely more competitive, but we have very unique products. So in personal loans, we're really not competing with big banks. They don't offer personal loans primarily because they have these huge credit card businesses that they don't want to cannibalize. So we're kind of competing with the smaller companies that don't have as much capital and they have higher cost of funding than us. So we've competed really well. But don't get me wrong, like I'm focused on funnels and pricing every day in the PL business. The student loan business doesn't really have a competitor in the home loan business. So overall, pretty benign environment at the top of the funnel, bottom of the funnel, nothing's changed, but it's always been competitive on pricing. And we're pretty nimble and have a significant advantage in lower funding costs than others. Not to mention a large percentage of home loans are cross-bought from existing members and increasingly a higher percentage of personal loans is cross-bought again without customer acquisition costs.
Your next question comes from Dan Dolev with Mizuho. Your line is open.
Hey guys, really nice results. Congrats. Just wanted to ask, maybe Chris, can you walk us through the rationale of not raising the EBITDA? Obviously, results are super strong. Just some color on that. I think a lot of investors are asking. Thank you so much and congrats again.
Yep, absolutely. Thanks, Dan. So we ended up raising guidance from a revenue perspective, about $100 to $200 million. That obviously reflects the continued strong execution and strong demand that we're seeing across the entire business. And as we've said before, when we see opportunities to deploy capital at attractive returns, we're going to lean into them. And that's what we're doing today. There are just too many large attractive growth areas for us to invest versus adding even more profitability. The profitability opportunity is not going to go away, but choosing not to invest today would come at the expense of capturing that growth opportunity in the future. The incremental revenue gives us obviously the additional flexibility to invest in initiatives that we believe will drive long-term growth while maintaining the EBITDA and EPS guidance that we've provided.
Dan, the other thing I'd say is we don't want to over-optimize for the actual EPS that we hit or the actual EBITDA that we hit relative to these bigger growth opportunities. but we also do need to be balanced relative to the environment. And while we couldn't be more positive about the demand for our products, the performance that we're driving with them, the credit trends we're seeing, the spending trends we're seeing, as well as the investing trends, all of those things are green and up and to the right. And so that's what's allowing us to drive such strong demand. It's not coming at higher costs, which I think is what a lot of people will point to. The incremental investment is on new growth opportunities. This year, we've launched a number of things that were never in our 2026 plan. We just launched big business banking. We launched SMB. We launched SoFi USD. We launched SoFi Crypto. And we're leaning into SoFi Plus because of how well it's doing. So that momentum is absolutely continuing. The other thing I would just say is we entered the year expecting rate cuts. We're now expecting 2 rate increases. We've not only maintained our guidance for revenue and profitability, we've exceeded expectations on the revenue side. So when we think about the back half of the year, I don't know if there's going to be 2 rate cuts. If they are, we're going to be fine. 2 rate increases. If there are, we're going to be fine. If there are no rate increases, we probably have upside to the bottom line. But we have the cushion in our guidance to be prepared to deliver regardless of the environment.
Your next question comes from Kyle Peterson with Needham. Your line is open.
Great. Good morning. Thank you guys for taking the question. Wanted to talk on the loan platform business. I think this is the second quarter in a row you guys have talked about the demand is really good from the buyers, but you guys aren't necessarily fulfilling some of the upsized requests based on like capital levels and unit economics for you guys. So I guess how should we think about, should that continue on the personal loan side moving forward as you guys still have really strong capital ratios? And I guess like is any of that volume decision impacted by HELOCs and SMB starting to get ramped up on the platform? Thank you.
Yep. Yeah, absolutely. Thanks, Kyle. So I'd say on how we're feeling about the PL business as it relates to LPB, we're happy with that level of volume. We're able to meet all of our contractual commitments and then some. And where you're going to start to see more meaningful growth is in some of these other asset types. And I walked through those earlier in the call during my prepared remarks and in the first question. As it relates to some of the capital consumption questions and how that pertains to LPB, what I would say is that we're self-funded through our guidance period and the medium-term operating plan that we've laid out. As our profitability continues to improve, our organic capital generation is going to continue to increase as well. Combined with continued growth in our capital-light businesses that Anthony's mentioned, as well as the flexibility that we have in how we monetize our originations, whether that's through the LPB program or on the balance sheet, we believe that we can operate comfortably within our target capital range without the need to raise capital under our current operating plan.
Your next question comes from Pete Christensen with Citi. Your line is open.
Thank you. Good morning. Really nice results here. Anthony, I'm curious, with introducing some of these more commercial-like products, how should we think about the cross-buy flywheel here, or I guess in the future, and putting it around some of these newer offerings? Is it, hey, there's a small business, we could connect to some of the proprietors there, maybe for personal banking, or do you envision some additional services that could serve, that market to increase cross-buy?
Yeah, what I'd say is the following: the most common sort of path or stage someone goes through is they come in through SoFi Relay or SoFi Money. They come through Relay, the most prominent next product is going to be SoFi Money. If they come in through SoFi Money, there's going to be a path to Relay or to SoFi Invest or to loans. SMB really was born out of the fact that a large percentage of our members actually are small business operators. And back during COVID, when the government provided PPP loans, we got a significant amount of demand for applications on PPP loans, even though we were not in the SMB business. We actually stood up an application process that met the government's application criteria and helped pass on that demand to lenders. And then on the back of that, we built a marketplace so that we actually get paid for that referral process that we're doing. So the SMB business is very much synergistic to the rest of our business. And I would think of it as just another use case for an individual to satisfy the needs they have from a borrowing standpoint. We'll obviously follow this up with checking and savings in SMB and other products that are ancillary to that. And so it will add to the flywheel. Big business banking, I don't think is truly appreciated by people outside the company. We were looking to partner with marketplaces and market makers in crypto, and everyone we talked to said, can you please be our actual bank? Can you build a fiat and crypto banking capability that's API driven? And that's where that business was born out of. And so not only will it be a business on its own, it'll drive second order benefits in driving more usage of SoFi USD. And the SoFi USD product is going to be driven obviously by the net interest income from leaving that cash at the Fed bank and earning Fed funds on it. And so we have a number of pieces of demand for SoFi USD. You have big business banking, which is now up and running, and people can use SoFi USD as a form of payment in those payment rails. We have our crypto business, which is actually settling in SoFi USD. On the consumer side, we have our debit and credit card with MasterCard. We'll begin settling in SoFi USD with MasterCard in the coming weeks. And so these businesses are starting to layer on top of each other, and there's synergies across them.
Your next question comes from Will Nance with Goldman Sachs. Your line is open.
Hey guys, thanks for taking the question. I wanted to ask a question on the SoFi Plus commentary that you had and some of the membership growth that you guys have seen. I was hoping you could maybe talk through just the profile of the customers that are adopting the product. You know, what have you seen from a wallet share perspective or an engagement perspective? Have you seen things like average deposit balances increasing or engagement with the SoFi platform increasing on the back of some of those signups? Thanks.
Yeah, our hope when we relaunched SoFi Plus is that it would increase the awareness of the other products that we offered that existing members may not be aware of or new members may not be aware of, because SoFi Plus is meant to be the best of every individual product. So if you sign up for SoFi Plus compared to just SoFi Money, you get a higher interest rate, you get other bells and whistles. If you sign up for SoFi Plus compared to just SoFi Invest, you get a 1% match. In each product, credit card, better rewards, et cetera. So of the 206,000 SoFi Plus members that we reported in the quarter, 85% of them are existing members. And it's the same demographic of our member base already because they are members. And the 25% incremental purchases of a new product after SoFi Plus, it's primarily the thing that's benefiting the most is Invest. And that's really encouraging. That means we're increasing share of wallet. We have investors for the first time that are novice to new investors, but we're also getting investors that are transferring their money because of the match. Secondarily, the SoFi Money product is the product that benefits if SoFi Plus is in that 15% bucket. So SoFi Plus is the first product of a member. The second product that they're buying is SoFi Money. In terms of the actual second order effects of their existing activity, a SoFi Money member that takes out SoFi Plus, 1/4 of them are taking out a third product, but we're actually seeing increases in their deposits on the back of that SoFi Plus subscription sign up, and we're seeing increases in AUM as well, and we're seeing increases in spending. So there is a benefit from more products being taken out from SoFi Plus, and there's a benefit from more engagement as defined by more deposits, more AUM, and more spending. Here's a really interesting data point. I looked back at the Q1 2021 cohort. Of the Money members in the Q1 2021 cohort that became Money members that quarter, with the launch of SoFi Plus, we increased the product per member of that cohort by one product in the quarter, which is, if you think about it, that's almost 5 years old, that customer that was acquired, and they added one product for the entire cohort in the quarter. So it's having a really strong impact, and that's why we mentioned in the earnings results and in my comments that we're seeing an inflection point benefiting from the flywheel. Crypto is also contributing to that flywheel as well as a new product.
Your last question will come from Matt Code with Truist. Your line is open.
Hey, good morning, guys. Thanks for taking the question. Anthony, I just wanted to ask about the spend down of that excess capital that you guys have talked about. So you're in that advantageous position where you have a really strong CET1 ratio, a lot of capital to spend, but you brought down that CET1 ratio pretty quickly over the past couple quarters. So could you talk about just capital, balance sheet growth, and kind of the spend down and the pace of the spend down of that excess capital?
Sure. I'll let Chris get into the numbers in more detail. One of the benefits of growing our balance sheet in Q1 and Q2 of this year is that we have very strong visibility into our revenue for 2027. And that visibility is going to continue because if we maintain our balance sheet at this size, it's going to produce the net interest income that's being delivered today consistently over time. Barring a huge change in the economy or overall credit performance, we can kind of count on that revenue in the future. And that's a really stable thing to have, so we can, at a minimum, fund a significant amount of investments regardless of the environment that we're in. And so when people ask, like, why are you putting loans in the balance sheet? Why are you not doing everything through loan platform business? It's because we want to make sure we have revenue in the future that's visible, that can deliver no matter what, and it's 100% in our control. We layer loan platform business on top of that, not just in PL, but now SMB and closed-end seconds. And it's a very incremental additive return on top of something that's very visible. And we have 5 years of history. I don't know if people heard the numbers that I mentioned about over $5 billion of cash net interest income from what we generated in Q1 of 2024 through Q2 of 26. But that's an astronomical number, especially where it's 2x greater than what the non-cash revenue was recorded as a premium over time, which shows that the loans are really performing. I'll let Chris talk about where the capital ratios will settle out, et cetera.
Yep. So we exited the quarter at an 18.8% total risk-based capital ratio, which is our binding constraint. That's well above the regulatory limit of 10.5%. As I mentioned in my prepared remarks, we believe that having a risk-based capital ratio in the low to mid-teens is appropriate for this business longer term. And like I said a few minutes ago, based on our current operating plan and the guidance that we've provided, we feel really good about being able to operate within those confines without the need to raise capital. As you know, as we continue to expand profitability, our organic capital generation will continue to increase. And by continuing to scale our capital-light fee-based revenue streams, that will help as well.
At this time,
Operator, I'd like to end with some closing comments. In closing, Q2 marks a clear inflection point in our strategy, where our Everything app is driving higher products per member, resulting in higher lifetime value, supporting superior levels of investment, and our ability to offer more value to our members than anyone else in better rates, products, and services. This continuous reinforcing cycle of the financial services productivity fuels durable growth and high returns. The benefits of this strategy, in our view, are no longer theoretical or a leap of faith. They are 100% in our control via disciplined execution. I'm often asked why I buy the stock, and the answer is simple. I believe we will achieve the returns that Chris walked through before of 20 to 30% return on tangible common equity, and it's just a matter of when, not if, the market can connect the dots to the attractive return potential of our business. Until then, we're going to keep our heads down and continue to execute and deliver for our members and our shareholders. Thank you, and we look forward to talking to you next quarter.
goodbye.
Jeez. That operator was so ready to jump off the call. It was crazy.
Goodbye.
Last quarter, it was exactly the same ending.
All right, I gotta jump. I'll see you guys.
See you later, brother. There were a lot of really good pieces in that call. There also is Trump comments on Iran while this is happening. So not all the candlesticks that you saw during the call were actually related to the call. That said, I don't know if you guys caught the $3 billion SMB deal that they just signed.
Yeah.
That's huge. $1 billion extra per year that wasn't included at all in any quarter before. There were...
Yeah.
Go ahead.
I really love too, like, it's not just, you know, the amount, $3 billion. That's good. It's having a different type of loans, actually 2 different types of loans that they could do in the loan platform business. Because there's times, like they talked about in the past, and a couple of hints in this call about it as well. There's times when some of those products, like, they're just going to be absolutely bonkers, but other times where, it's going to shift around. It'll be a mix shift. So this gives them some resilience with the loan platform business. I like it.
Neil, initial thoughts?
Honestly, nothing special. Nothing crazy was mentioned other than that 3 billion number. What was it for base point over 3 years? So all in all, did I want to hear something else? No, not really. They just, again, we got the guidance. They're now expecting 1 to 2 rate cuts. So now we know, right? We know that their guidance 1, revenue is raised, EPS stays the same, could have been 65 cents if the tax rate was a bit lower. But again, their assumptions are getting worse by the quarter, and yet the numbers keep getting better. So I don't mind.
Yeah, rate hikes, not cuts. But I don't even think they said 1 to 2. I think they said 2.
they said 1 to 2, or Noto did, and then, or no, not Noto. Lapointe said 1 to 2, and then Noto said 2 when asked about the question. So they are baking in 2. It was funny too, because when Noto said that, he said, so if we don't have these 2 rate hikes, we might expect some upside on the bottom line. It's like, might. But yeah, it shows how strong the company is, but also B, like, how much they sandbag the guidance when you go for basically there's 100 basis points difference between expectations going in to the year versus where we're at right now as far as guidance, and they're still like, hey, let's go ahead and increase that on the top line.
Yeah. Overall, and this fits Neil's investing strategy so much, it's business as usual. This is a company that you signed up for them to compound revenue, members, and earnings over time, and that's what they're showing up to do. I like what I see here in terms of the numbers. This is exactly, a lot of these numbers are very, very close to our expectations. And while I expected a little less on lending and a little bit more on financial services, it all came in regardless and actually beat a lot of our expectations. So what more do you want? I know obviously you could say stock price, but those are the things that they can't control. The things that SoFi management can control is how the business is actually performing, and it's better than what we expected. So classic SoFi triple beat and sell off, seemingly another quarter like this. But also, it's not required that SoFi goes up on its earnings releases. So I don't think it's also fair to say, okay, well, now this company is dead money for the next 3 months. Let's see what happens at FOMC. Let's see what happens as they launch new products, as they sign new deals. Will another Fortress Group-like deal end up coming through, and then the stock move on potential new loan platform business? Or, they talked about signing another deal. They said several $100 million going to an undisclosed partner for SMB. Maybe SMB becomes a real line item for them. I think whenever betting on a company long term, the way that we're betting on SoFi is you have to bet on management. You have to bet on their, the platform differentiation. Like, is there a reason to use SoFi over a Wells Fargo, a Citigroup, something like this? And if you can spot those trends and continue to see that they're going to grow over time, then how worried are you whenever they're growing in market share across practically all segments? Is there disruption risk or something like this? Are we seeing any of that? And I don't think we are. I don't think many companies growing at 40% worry too much about disruption.
Yeah, they're the disruptor, not the other way around.
Exactly.
And I read some comments saying that, we bought it at a cheaper price when it was $6, $7. SoFi today, valuation-wise, is cheaper than when we bought it at $6, $7. Because at $6, $7, we didn't have any earnings. So, yes, Tanner, what did you do there?
I'm so sorry. It was me or Roy. I had to do it first.
But yeah, company-wise, the company is in a much better place today than where it was at a lower stock price, which, okay, I know if stock price was much, much higher, everybody wins, great, but it's still a better company today than it was at $6 or $8. I didn't include the 7 there.
Yeah, and a lot, as far as the move today, it's going to come down to what happens at the FOMC meeting in the comments there. So, we're still looking at, a 1/3 chance of it raised, which I think is, I would be really surprised if they raise this one. Now, September, that could be different. And of course, they could be like, well, we're not raising, but we are open to maybe the next meeting, whatever the comments are, we'll have to see. But that's going to really determine the direction. And, we could end up quite green if there's no hike.
JP Morgan expects the Fed to hold rates today. So
yeah, that just came out. I saw that. Mind you, this is also really important, and one of the things where I was talking about how people are not going to be as excited about SoFi this quarter is that a lot of the banks did extremely well. Like JP Morgan is just a juggernaut of a company. And they grew revenue by like 27%. And all the categories that they did extremely well on, SoFi doesn't really operate in. Wealth management, investment banking, all of these advisory. SoFi doesn't even operate in those areas. Where JP Morgan grew by 5% was in consumer. And that's where SoFi is operating. So this really is like not the greatest macro for them. They did not nearly benefit from the IPO season. I mean, they have IPO access, but it's not nearly the same as what JP Morgan and the other syndicate banks are getting from actually helping with that IPO. So the biggest tailwinds in banking right now, SoFi's not really placed well for that. And where things are looking pretty weak for Wells Fargo and Citi and JP Morgan, SoFi just continues to dominate. So whenever the tailwinds turn back towards consumer, SoFi is going to be greatly positioned there. One of the ways that I look to see if they're growing pretty well is just seeing the health of SoFi money. That is the bread and butter, and that's going to be what I believe determines their success. Deposits grew by $4.5 billion. Did anyone catch that? That's practically like a double quarter for them. That is by far their biggest quarter of new deposits. And I can show you a quick little slide here. But it is skyrocketing right now. And on top of that, the amount of deposits per member is now at another new high at $5.4 per SoFi Money account. But that's up $400 per account quarter over quarter. It's very, very big. On top of that, they also showed off, let me see if I have a chart for this. If you guys caught Chris Lapointe's comments about the amount of spend, they said they did $28 billion of annualized spend from credit cards and debit cards. If we take a look at that in Q2, let me share my screen again. What that ends up showing us is that we're now seeing roughly $887 of spend per account, which is up nearly $70 quarter over quarter, a major uptick in the amount that people are spending through their SoFi accounts. This is not the biggest revenue driver, but it is the greatest indicator of activity. For the people who have followed Nubank and these sort of companies, activity is what drives revenue. You spend more time on SoFi's accounts, you're likely to sign up with them with a home loan. You're likely to sign up with them with future products, whether that's SoFi Crypto or SoFi Smart Card. And then that is the flywheel. So I would likely bet that many people here who have been investors of SoFi for a long time bet on that flywheel. I don't think that there's been a better time based on those two metrics alone that SoFi's flywheel is not working more than ever at the highest amount of products per user. If that's what you're investing in, SoFi looks insanely well positioned right now. It's just a matter of, are loans going to be able to get sold? Are they going to be able to turn that money around as fast as they want? There are macro challenges, But if you're blaming Noto, which I see a lot of comments doing here, he has not executed at this level in a very, very long time. Like, he continues to do so well, and I would continue to push my chips in his direction. But I'm curious if you guys have thoughts on anything that I said there.
I mean, he's pushing his chips in SoFi's direction as well. So
Exactly.
Yeah, no, I like I do wish that they had made the change the way that products were kind of just so we could get the pure number of be able to compare apples to apples with this cross sell. And it's clear that they're offering more products, better products as well. They're seeing a lot of growth in like interchange was one of those big jumps sequentially quarter over quarter, and it's they have basically a lot of different growth levels, a lot of different ways to monetize that base, which is growing over 1 million every single quarter, which is just something that we shouldn't be taken for granted. And they do a pretty good job of cross selling. I think it's going to get stronger as the future grows, and that was one of the analyst questions there, which I think is a good question of basically how do you monetize that base then, because EPS is relatively flat. A lot of it is because, of course, they are launching all these products at the same time. They have additional marketing expense pushed into the second quarter at the same time as those payroll taxes. So, but yeah, regardless, like this, if you're looking out a couple of years, this EPS number is just going to swell from here as these products get more and more adoption, as they continue to cross-sell, as the flywheel gets stronger as well. So really important quarter, good quarter. Stock price is not the only measure to go by. It's probably the worst measure to determine like whether the business is healthy or not. But
legitimately the worst. I think there's a famous Peter Lynch quote about it, right? It's the metric that most people follow and offers the most inaccuracy. I forget what it is exactly. I'll try to find it, but yeah. Are we sticking around until 9:30, or do you guys care little about where this is going?
I think with the FOMC meeting, it doesn't matter as much how we open up, because I mean, if it opened up brilliant green, I mean, we could get something bearish at FOMC, or we could open up even down further, and FOMC is like, hey, we're not hiking; it's going to be green.
See someone in chat saying they effing hate the stock market.
That's
welcome
the
to the club, baby. This is what it does. You see your friends get euphoric pricing, you try to follow them in, and then you get destroyed. But if you stick through it, I promise you, you'll be the one early in that cycle as well. It happens. It's a game of unbelievable emotions. And honestly, it is awesome. It is. Doesn't always work on the day that you want it to work. But if you bet on compounding companies and stick with it, it usually yields favorable results.
Yeah, certified AI developer had the quote from Peter Lynch: "The stock price is the least reliable indicator of a company's value and is the most unfaithful barometer of its development."
Bang. I think that's SoFi in a nutshell right now. And also is in our favor in certain environments as well. Like whenever we went from $7 to $32, probably also wasn't justified in terms of did the company just, 4x or, but companies can give companies incredible, investors can give companies incredible premiums and also take them away quite quickly, depending on shifting macro.
And rate cuts would help, but you're raising guidance into uncertainty, expecting 2 hikes. This is a company that's going to be just fine, even if they hike. If they don't hike, it's going to be very exciting.
When you have Stripe trying to buy OpenRouter for 70x its annualized revenue, and now we have a SoFi that can't even catch a beat. So,
dude, SoFi doesn't even pick up my calls, let alone pay me. Right after this, I'm going to be literally on Robinhood's earnings call. You think they'd want to pay me to talk about how nicely I'm going to talk about their competitor? It's funny, right? Whenever a stock is going up, people are like, oh, great company. Whenever it's going down and the company still grows by 40%, they're like, you must be paid to not talk crap on this company right now. And it's like, point me to the metric that you're seeing. Are you really? You think that I'm getting paid because I'm not complaining about tax rates? Like, give your head a shake, you weirdo. You know,
No, it's we're getting paid when we are bullish on a name, and then when we are bearish, we are short.
Yeah. You're short. You're getting paid by the muddy waters of the world. Either way, you don't have a damn action in your life if you're not being paid for it.
Just an
No.
FYI, Nebius earnings 2 weeks from today.
That's confirmed?
Yes, August 12th, before the market opens.
Yeah. Tevis is not getting fully paid. He left early, which did not fulfill his contract. So
more for us.
We're getting paid extra this episode, ladies and gentlemen. Okay. That being said, though, I don't really care to stick around for 10 minutes. I think that we should wrap here. Roy, I don't know what you're doing later. I'll be live. Neil, I'm not inviting you. I just assume you'd be asleep, but you're also welcome to join as well. If you guys want to listen to FOMC together, that should be from... What time is it?
No,
there?
I'm going live with Jose for Meta and Microsoft when you're dealing with Robinhood.
How are you? What time is it?
Now it's 3:20
p.m.
Yeah.
Neil can sleep after earnings is over.
And anyways, at 1 a.m. I have to go to the hospital for a MRI scan, so weird schedule today. It's either that or wait a month for the appointment. So I rather just go in the middle of the night.
Taking
so you're not
appointments
sleeping
at 1 a.m.
Yeah.
All right, we good there?
Yeah.
Yes.
Ladies and gentlemen, thank you all so much for watching. Really do appreciate your time. Consider subscribing to our 3 channels. I should include Tevis as well, but he bailed on us. All right. Thanks, guys. Bye for now.
Later.